We get a lot of questions about bear markets, guys. We're going to talk a little bit about day trading specifically. We've had a ton of questions recently regarding how we should adjust our day trading skills and our day trading strategies in general because we're in a bear market. And I'll even throw the question out at this point, does it matter if you're a day trader that we're in a bear market?
I say it does. So my answer to that would be a yes. And I think actually having traded yesterday in the afternoon, for those of us that were watching yesterday in the afternoon, everybody likes trying to buy the dip and catching bids. So the simple thing that I would suggest is, in a bear market, resistance matters more than support. It sounds pretty obvious, and I suppose it is obvious because the market's heading down, but it matters. And that simply means you should have far more confidence shorting in front of resistance, covering longs in front of resistance before it breaks through, than you should have buying in front of support. That's all it works out to. And just as an example here, I'm going to show you Microsoft. I'm choosing Microsoft because it kind of shows the point a little bit better than most other things. And obviously, it's a little bit of a cherry pick, but I think it demonstrates it pretty well here. You look at the last little bit, it had this resistance level at 275, and you can see how many times, or 74, 75, how many times it's able to sort of break out, not sustain it, reestablish, try to break, can't go. But what happens each time it gets away from that level? It's rejecting that price level to the downside more than it's able to ever break out. Right? So the move is stronger southbound off of the resistance level. And then what happens at your support levels? Okay, well, you have a little bit of support here that goes one stage up. Okay, doesn't quite even get into our big resistance. It goes close. We had a wipeout bottom, a little bit different because this here support is actually broken. You have a V-shaped wipeout bottom that actually tracked $5 below your support. So that's actually breaking your support and then retracing it. So you can't really count that. And then what happens when you actually break down and hold below support? Well, I'll tell you what happens. You blow through multiple levels. Like you flush away from that price. There's no wick. None of that nonsense. Even this wick here, when it breaks the 65, like that's a $4 or $5 wick. When it broke the 73 area, like it went $2 or $3. Like even that wipeout was bigger than your breakout. And when you held below, it's just absolutely flushing. So there's a bigger reward from a consistency level to respect the resistance, consistently trade off of it to the downside, and then understand when support is broken. Instead of trying to defend it, you should just go with it. I could have shown Micron when it broke that support level down, downside, then you have it turn into resistance. But I like Microsoft here because it shows you the value and the consistency of just shorting every single one of these tops. And in a bull market, when you're just buying the dips, great, of course. But we're in a bear market, so you got to adjust your flow.
That's right, got to address your flow. And to me, I think you also got to address your share prices. In such a bear market, you got to be careful about the market volatility that starts to accelerate higher and higher. This means a lot of things. One being that the option prices are a lot more expensive now, since the range of where the stock might end up a week or two from now starts to increase as the market's preparing for a huge move one way or the other. But this also means that you got to be careful, like Neal said, about your support resistance levels, since they can just blow through on heavy volume buying and selling. The common saying, I think, goes stairs up and elevator down. Crashes are nasty and they happen like a flash. So you got to be careful with your share positions, and you also have to make sure you have a stop loss because they can blow past at any moment. And of course, stop losses go both ways. You could get saved, or it might just go against you and move right back up. So that's always an issue you got to worry about. I think for me, the biggest thing in bear markets as well, there's a lot more opportunities, let's say, in the option markets environment, where premiums are now much higher because of the implied volatility being elevated. You can see here on the VIX now nearing 30 for the S&P volatility. This is a traditionally high level. You don't really see it stay at this level very often. Throughout 2021, we've seen it much lower, around 15 or 20. I know for a lot of these tech names like Upstart, we've been seeing higher realized volatility as well as implied volatility. A lot of these names you can trade monthly options with 120% annualized implied volatility. So this is an option selling environment if you believe that some of these stocks will pretty much consolidate or stay at the price they currently are for the extended period. But also, if you're trying to bet on a huge move one way or the other, prepare to pay up a little bit more money, just because I think the market already priced in the possibility that there will be a huge move as well. So, a lot of opportunities to go with in the options market, a lot more strategies as well that become a lot more lucrative. If you want to take a look at calendar spreads, for instance, really interesting payoff if you believe that the stock will either consolidate for next month or will move in a huge direction. Calendar spreads, vertical spreads, always fun to play with. I know Danielle Shea unfortunately wasn't here yesterday, but she'd be talking all about that. And so be careful if you're an option buyer in this environment. But that being said, I think option buyers, if you also have those diamond hands, will be rewarded quite nicely, since these huge moves are no joke. So just be careful about your share sizes and be careful about getting stopped out, because this is a very volatile market and oftentimes towards the downside. So just be careful about that.
Directionally, things change this year, definitely back to the downside. If your time frame is days, if your time frame is weeks, if your time frame is even intraday, we have to be able to adjust to the market environment we are working with, higher volatility. And just because you're moving in one direction doesn't mean there aren't great opportunities on the long side, though. So definitely some changes in a bear market if you are a day trader.